The dollar index, also called the DXY, measures the strength of the US dollar against a basket of 6 major foreign currencies. It's like a report card for the US dollar, showing how strong or weak it is compared to other global currencies. The dollar index is a key tool for traders, investors, and economists to track the dollar's value and its impact on global markets. The DXY is based on 6 currencies: the euro, which makes up about 57.6% of the index, the Japanese yen, 13.6%, the British pound, 11.9%, the Canadian dollar, 9.1%, the Swedish krona, 4.2%, and the Swiss franc, 3.6%. The euro has the most significant influence, so changes in the Eurozone economy often have a big impact on the index. Here's how it works. The dollar index starts with a baseline of 100, set in 1973. If the DXY is at 110, it means the dollar has appreciated by 10% compared to its value in 1973. If it's at 90, the dollar has weakened by 10%. The index moves up when the dollar gains strength and down when it loses value relative to the currencies in the basket. The dollar index is influenced by several factors. One major factor is interest rates. When the U.S. Federal Reserve raises rates, the dollar typically strengthens because higher rates attract foreign investors, increasing demand for the dollar. Economic performance also matters. A strong U.S. economy boosts the dollar, while weakness can lead to a decline. Global events, like geopolitical instability or financial crises, can also impact the index. When there's uncertainty, investors often turn to the dollar as a safe haven, causing the index to rise. Let's use an example to make it clear. Imagine the DXY is at 95 and the Federal Reserve announces an interest rate hike. As a result, foreign investors rush to buy US dollars to take advantage of higher returns. This demand increases the dollar's value, pushing the DXY up to 100. On the other hand, if the US economy weakens or interest rates drop, the dollar becomes less attractive and the DXY might fall to 90. The dollar index is closely watched in the forex market because the US dollar is involved in most currency pairs, like euro to US dollar or US dollar to Japanese yen. For example, if the DXY rises, it usually means the dollar is gaining strength, and currencies like the euro or yen are weakening relative to the dollar. This can create opportunities for traders. Suppose you're trading euro to US dollar and the dollar index spikes. You might consider selling euros because the dollar is likely to outperform. The DXY also impacts other markets, like commodities. Gold and oil, for instance, are priced in US dollars. When the dollar strengthens, these commodities often become more expensive for foreign buyers, leading to lower demand and prices. Conversely, when the dollar weakens, commodities can become cheaper and see increased demand.